Well, hello, you trader nerds. It is a terrific Thursday. Hope everybody's doing well. I just got back from Chick-fil-A and had their honey pimento cheese grilled chicken sandwich. Oh, sweet. It was good. Had jalapenos on it, a little spicy, and the honey with the pimento cheese was amazing. So the Lord's chicken did and then I said I want it grilled instead of fried, and I think that's the way to go. And that sandwich was delicious. Now, me, my mama, and my daughter all got one, and I got one Diet Coke, and they got ice water. $27 for three sandwiches and a small Diet Coke. That is unbelievable, but it was really good. So maybe we could splurge on that like once a month or so. But that was a heck of a lunch we had today. So good morning, everybody. Hope everybody's doing good. Real traders never trade alone. They trade with their fellow nerds like Austin and Bull and Carlos and Daniel and DB and DMT and Dunn and Dwayne and Edwin and Hal and James and Jason and Jim and John and Mo and PSG and Ricardo and Thomas and Tyler and Vicky with an I and Vicky with a Y and Bo and William. Welcome in. Cheaper than Burgerville. What is Burgerville, Austin? Never heard of Burgerville. Sounds good though. I want to have me a good old smash burger. I've got me a Blackstone griddle and made smash burgers on that. That was really good. Now if I had some pimento cheese on my smash burger, ow, ow, waka waka. So welcome in, ladies and gentlemen. Let's start off with linear regression. Look at this. We violated our little thing here, and now we violated ourselves to the upside. It may be now that we are beginning an upward trend to the overall trend, the long-term trend, which is up. So it will be interesting to see if we continue out of that. But I will bet we'll have a couple more days of consolidation here. That's just what I think, because we really didn't have an area of consolidation. It was just down and then up. So normally we'll have a little bit of consolidation. I don't see it now. So I got a feeling we're going to be down a couple of days here. But well, who knows? Who knows? So let's see how our little thing here. Hey, Carlos. P&W Burger Place super expensive. Yeah, I bet so. So let's see our little charts are showing today. So the market's not really doing anything. It's up 7 points. Um, yeah, up 7 points. VIX is down 17.52 and AD is negative 21. We're still kind of in that opening 15-minute range. We got the cash open here, so not a lot to see. Let's see what the big green monster looks like. Where is my big green monster? Where is everything? Actually, let's see. Big green monster. Look at this. This kind of called the lows, didn't it? My chart's a little bit off from where that low is, but we had support down here at around the 54.10 or so. And then we have bounced back up into, just like we said, you remember me saying we'll spend some time down here and then we'll probably pop back up into the fair value zone. And we're in the fair value zone and with a target ahead of 57.41, which would be really, 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 really interesting. Now, what I wanted to do is talk about this concept of having weekly income, generating weekly income while having a hedge. And let's just look at something and see how this would look. So let's say that we went to QQQ, okay? QQQ. And we'll try it in an SPY too. But I just wanted to see if we could generate a little bit of income. And if we went out to 7 days, okay, and I'll share the information where I kind of got this trade from. But if we went from 444 and we sold the 444, and let me get my little calculator. And I said I wanted to do a 25 wide credit spread, put credit spread minus 25 would be the 419. So if we sold the 444 and we bought the 419, everybody just kind of look here, that would give us 47 cents of credit. Okay. Now, the maximum loss on this would be 24.52, and your maximum gain would be the $48 that you ended up getting. Let's move this just to, well, no, that's fine. So that would be about $500 if we did a 10 lot. And you'd be taking $25,000 worth of risk, but I just want to show something here and see how this looks with our little hedge here. So this would mean that we would bring in $480 worth of profit. So let's just say that we wanted to generate about $500 a week. That would be what we'd want to do on our little account here. And this would do something, but we'd have $24,000 worth of risk, right? But remember, we do have a hedge, and it'd be interesting to see what this looks like with the hedge. So let's go over here, and we'll try this in SPY as well. Let's go over here to our little hedge. I said, let's go over here to our little hedge. Let me close this and open it back up. So let's go to positions. Let's go to count requirements. Let's go, here we go. So let's do all of this. And let's do my 12 on there, which are about to expire, aren't they? Let's see how they're looking. Not expire, but they're about to be closed. Let's see what my activity says. They should be 30 cents. Look at this, y'all. Oh, yeah. Mm-hmm. I'm good mind to go ahead and just close them for 25 cents and be done with them. Get my nice hedge up. So this is what our hedge looks like. We've got a $22,000 hedge on there. Now it'll be interesting to see how this hedge holds up with the orders of the QQQ credit spread that has a $24,000, right? We've got $22,000 hedge here. How would it look if we put on this credit spread with 20 something $1,000 worth of things? So let's see if we could do this. Aha. Aha. Now this is interesting. So basically, it's saying now this is at a 20% down, and it looks worse if you don't go down that much, down 4% with a shift of volatility of 40% like that. We're still down $2,400, but that's actually reasonable, right? So instead of us taking $24,000 worth of a hit there, we're only taking a couple $1,000s worth of a hit in order to try to generate 20 or $500 a week. That is interesting. How does my hedge look without those 12, which are about to come off? Oh, behave. I am looking good. So, what I'm thinking about is doing a weekly trade so that we bring in a little bit of premium every week and that it's perfectly hedged to the downside. So, that's kind of what I'm thinking that we need to do. That's our income trade. So, let's go and look, see if we can do this in the same, like in SPY. Or we might could use XSP. We'll see. But let's go back over here and look what it looks like over here. And let's go to SPY. So if we were to go trade SPY and we did the 7-day option, well, we got options every day now, and we were to go basically to that same 60-cent put, which would be around an 8 or a 9 delta, right? So let's say we went to 534. 534 minus 25 is 509. Let's do 25 wide strikes. 509. We don't have 25 wide strikes. We'd have to go to 510. That would be good. And that would bring us in $460 if we did 10. Let's go do this. 7, 8, 9, 10. In other words, I'm trying to figure out how. Okay, Tyler says, but even when those 20 shorts come off, don't you need to sell more puts and add more risk to keep the factory going? And that is true. That is true. So it won't be quite as good and robust as it looks all there. So you're right. We'll need to sell some more puts to keep the thing going, right? So this would allow me to bring in $460. We're trying to make $500 a month. Let's see if we can go this way. We'll go to the 535 to make that 20 points wide. So that would do it there. That would bring us in $530 a month. So let's go back to our little bitty thing. And let's take off the order legs. And let's put these back. And let's now add these order legs. Okay. Now that's interesting. It's not like as robust as the other one, is it? That's interesting. This actually does have risk in it, but in other words, here's what I'm trying to say. If we've got a $75,000 account, I am trying to figure out a way that I could bring in, let's just say $500 a week, right? On a weekly option times 52 would be bringing in 26,000. 26,000 divided by a $75,000 account is a 33% return. 34% return. So that's what I'm looking at in order to get us some income. Is um, a very short term, 7 days, just to say bring in $500 a week, and then making sure that we are hedged to the downside. In other words, there's no chance that we're going to blow out our account or have a serious loss like we had back on August the 5th. I think this might be the way. Now, is Rick in here? I'm trying to remember what the Rick trade was. Does anybody remember what the Rick trade was that was so successful for so long? It was using SPX, and I can't remember what that was. Let's see if we could use XSP. Now, why would I use XSP? Well, because let's see if the how the bid ask price in XSP are. Okay, XSP has all the expirations that we want. That's good. Let's go down to the 60 cent option, which will be about a 8 delta. That's fine. So sell the 535 and buy the 510. That'll bring in 48 cents. And that would bring in, let's do 10 of them. Here we go. Let's see if it looks the same. The only reason you do this is because of the 1256 contracts, right? We probably have enough liquidity there. So let's pull this up. And let's see, let's take off our order legs and let's add our order legs. Okay, that looks a little better, doesn't it? But in other words, this is a way, any value to doing a 2 lot trade daily. Yeah, you could do that. What are you talking about? Doing it on a 0 DTE or doing it 7 days? Oh, I see what you're saying. We could do it 7 days, a 2 lot trade. And yeah, that would be kind of interesting. Let me think about that for a second. 2 lot trade and do it 5 days a week. That would get the 10 in, and we could have a trade that we could do every day. I kind of like that. I like that, John. It's a good idea. So y'all see what we're doing? We're trying to say, okay, let's figure out a way, since we've got this hedge, we've got this nice hedge. How can we have a short-term income trade, term income trade against a long-term hedge? Now we're going to cover this in Muscadine Mafia tomorrow, but I'm basically going to show you what we're going to do. So what we're going to do is we're going to try. I don't think Carlos doing the 1-1x. Now some of y'all are saying, "Hey, I'm going back to the 1-1x. 95% of the time it's great and that's everything." I'm just saying, we're trying to rack our brains here to come up with something that's just going to be a little better. And I'm thinking a weekly so that we can bring in about $500 of premium per week, and we're going to sell a 60 cent option, and we're going to buy one 25 points below. Now, what if this thing goes against us? All right, you ready for this? Here's what we're going to do. So in this instance, we were selling the 535. What if the market goes down below the 535? Well, we would be assigned shares, right? We would be assigned shares here if this goes in the money. But no, we don't want to take assignment. So what we would do is we would close the spread, okay, on the day of expiration. And then we would go out to the call side and we would sell 10 calls at this strike. We would sell 10 calls at the 535 strike, okay? And we would go out about 150 days. Now, this is only if this strike is in the money. Then we would go out about 150 days. 150 days, we go out 141 days. And we would buy probably the 532 here. We would buy 10 of those. So basically, now what we're doing is kind of like a poor man's covered call. And we would continue selling that 535 strike every 7 days until the market closed above the 535 call strike. Then what we would do is go back to selling our weekly put. Yeah, so it would take up about $25,000 worth of buying power. That's what it would take. So yeah, $25,000 worth of buying power. So you wouldn't technically need portfolio margin. You just need a count that could hold the 24,000. But um, if you've got the buying power, which we do here, this is very, very interesting, y'all. I really kind of like this because what we do is we sell a weekly put spread every week in order to try to generate $500. On the weeks that the market goes down significantly, we close the spread, take our loss, okay, take our loss. But then we say, okay, if the market continues going down, we're going to be fine because what we're going to do is we're going to do a poor man's covered call. We're going to sell the call at the same exact strike of the short put that was breached. And then we're going to go out about 5 months, say 150 days, and we're going to buy a slightly in the money put as a poor man's covered call. And we will continue selling that 535 put every week until again markets have a positive drift, a positive bias over time, and then we're going to once it closes above our short call, we're going to close all of that and we're going to take the profits from it, or we'll take the loss and then we'll start back doing the puts again. That sounds really, really good. So I'm really kind of excited about this. It's going to take, now it doesn't look like it worked out good on the thing here, but keep in mind, we're doing just more than doing this. The times that it's breached, we're not going to take assignment. We're not going to take assignment. We're going to close that put debit spread. We're going to take our loss. We're going to sell a call. We're going to do a poor man's covered call against that. So that the plan is we're going to generate $500 per month, per week. Go. And the good thing is we don't take a $25,000 loss if the market blows past both of our strikes because we have the sweet Bobby hedge. So hedge plus income equals Sweetness. I think that's how we do it in. All right, CE says, I'm coming in late, but what's the protection if market keeps rolling down? At a certain point, you won't get much for the covered calls. Right. So we would have to roll the 535 down a little bit. That's what we do to make sure that we still keep getting uh, a decent credit for it. Yeah, I think, Vicky, you could do this with MES. I think you could. I think you certainly could. It depends on what the credits are. It would, if you were to say, I'm going to do the 8 delta, and you got to figure out it's probably not going to be 25 wide strikes there. You need something to make the credits sufficient. But I'm going to tell you where I got this from. Okay. One of my students, Mark, that I'm doing one-on-one with, I'm about to do it with him here at 1 o'clock. Showed me it was an SBH Capital video, and I'm going to share that video with you guys tomorrow. Okay. So everybody, hang on. I think we're close to saying, hey, let's have a hedge. Let's use that hedge to generate income. And then our hedge is not going to be the profit center that we wanted it to be during a crash, but we don't care because we're generating $500 a week in income. I think that's the case. All right. Good session, y'all. I appreciate all of it. Love you to pieces. And I will see y'all tomorrow. Tomorrow. The sun will come out tomorrow. Where's my thing at? Here we go. All right, y'all. Where is my thing? Hold on. Here we go.